Welcome to TalkTickers. Thanks for joining us for another deep dive into the latest earnings calls. Today, we're looking at the Buckle, Inc. That's ticker BKE, specifically their Q2 fiscal 25 results. You know, in this retail climate, which is, let's face it, always changing, Buckle seems to be, well, more than just surviving. They're really showing some impressive adaptability. And the market's noticed. The reaction's been pretty positive. So let's dig into why that might be. What really stands out with these results is how they seem to show a deliberate strategy really paying off. Buckle had a frankly stellar second quarter. Diluted EPS, earnings per share, came in at 89 cents. That easily beat the consensus, which was more like 80 cents to 83 cents. And revenue, also strong, $305.7 million. Again, sailed past the $292.6 million expected. That's up a healthy 8.3% year over year.
Yeah, those are solid beats on both top and bottom lines. Really sets a positive tone.
Exactly. And it wasn't just headline numbers. Comp store sales climbed 7.3%. Their online sales absolutely surged, up 17.7%, hitting $43.6 million.
Wow, that online growth is significant, almost 18%.
It really is. Operationally, too, they seem to be getting more efficient. Gross margin expanded about 50 basis points, to 47.4%. And operating margin also climbed up to 18.4% from 17.1% last year.
That shows good leverage. And SG&A?
SG&A, selling, general, and administrative expenses were trimmed down nicely, too. About 29.0% of sales now, down from 29.8%. So, I mean, on the surface, looks like a clear win, right? But for experienced investors like you listening, the question is how they do it, and what does it really say about their strategy long term?
Exactly. These aren't just numbers floating in space. They point to, like you said, very intentional execution. My read is that Buckle's proving that even when things are tough out there, if you have a focused approach, merchandising efficiency, multi-channel, you can drive real value. So yeah, let's pull back that curtain, look at the drivers. Those margin improvements are probably the best place to start. They tell you a lot about their discipline. That 50 basis point jump in gross margin, it wasn't luck. They broke it down. 10 basis points from better merchandise margin.
Meaning selling stuff for more, basically, or better product mix.
Yeah, good product appeal, pricing power, maybe mix, exactly. Plus, a big chunk, 40 basis points, came from leverage in what they group as buying, distribution, and occupancy costs.
Okay, so efficiency in the supply chain, keeping rent and related costs in check relative to sales?
Pretty much. Suggests tight control over those operational levers. Now, the SG&A reduction, that's quite interesting too. A big piece, 65 basis points, was because they cycled off some one-time digital commerce investments from last year.
So a non-recurring item falling off helps the comparison.
Precisely. And they actually mentioned this benefit should carry into Q3 as well. So it makes this year look better without a new comparable expense popping up yet. We also saw store labor costs down 45 basis points and other SG&A down 55 basis points. Good discipline spending there.
Okay, but wasn't there an offset?
There was, yeah. Good catch. These gains were partially offset by an 85 basis point increase in incentive compensation accruals.
Which usually means people are hitting their targets, right? So maybe not a bad thing.
Generally, yes. It suggests they're rewarding strong performance across the company, which is often a positive signal, despite being an expense line item.
Okay, that makes sense. But let's go back to the merchandise margin for a sec. You said it was up 10 basis points. I think it was actually higher in Q1, though, wasn't it? Should we be worried about that slight slowdown in Q2 growth, even if it's still growing? What's the story there?
It's a fair point to raise.
Yeah.
And yeah, the growth rate was higher in Q1, but Q2 growth was still, in their words, pleasing, and it came off record levels, driven by strong full price selling. The slight deceleration, they explained it as sort of a natural cycle. Their private label mix was apparently a bit lower in Q2 than Q1.
Ah, okay.
And at the same time, they had really strong selling of their national brands. So it's not necessarily a negative. It kind of shows health across the whole portfolio.
Right. They're not just relying on one thing. It shows balanced demand.
Exactly. It demonstrates they can move both their own stuff and third-party brands effectively, not overly reliant on just one segment.
Got it. And occupancy, you mentioned leverage there overall, but I think occupancy sits itself was actually up more in Q2 than Q1.
Yeah, occupancy expense specifically did increase more, about 5.5% in Q2 versus 3.5% in Q1. But again, context is key. This isn't necessarily a red flag. It's tied to strategic investments. They opened new stores. They did planned remodels. Importantly, some of those are relocations to better off-mall spots.
Okay, investing in the footprint.
Right. And there was also an uptick in percentage rent, which, is a direct result of having stronger sales. So it's not just spending, it's spending linked to growth growth-oriented capital allocation, basically.
So strategic store investments, cost management, how does this link back to the products they're selling? Is this where that famous private label strategy comes in, driving sales in these improved stores? It's been such a consistent story for them.
Absolutely. You could argue the proprietary brand strategy is the linchpin here. It's quite remarkable, actually. They've pushed that private label penetration to 43.5% of total sales.
That's huge.
It is. And they highlighted it's been 10 consecutive quarters of growth for those brands. 10 quarters. And apparently without hurting their national brand sales too much.
That suggests some real merchandising skill, right? Balancing those two.
Definitely. Premium internal brands thriving alongside the external ones. It's a key driver for their margins, obviously, but also for building, deep customer loyalty. You wonder if others can copy it or if Buckles just found this unique niche. Are you going to lean towards the latter?
I think I agree. It feels very specific to them. Now, looking at the categories, women's wear really jumped out. Sales up about 18.5%. It's almost half their business now, 47.5%.
Big acceleration there.
Yeah, and within that, women's denim was up huge, about 20.5%. And the average price, the AUR, went up too to $85.35. They also specifically called out their black label denim. That's one of their own brands, right? Saying it actually did better than the overall denim business.
That really underscores the strength of their private labels. Customers are clearly buying into them, even at higher price points, it seems.
For sure. And it wasn't just women's. The kids' business apparently had outstanding growth, up around 23%. It's still smaller, 4.5% of the total, but growing fast.
Yeah, that's a segment really gaining traction. Could be bringing in new families, future shoppers.
Good point. And menswear, which had been a bit flat, returned to growth. Up about 1.5%, still the larger part of the business at 52.5%, mostly driven by men's denim, up 4.5%, with its AUR also increasing to $89.30. So kind of broad-based strength.
Mm-hmm.
Oh, and accessories were up too, about 9.5%. Footwear was the only slight dip, down about 0.5%. Minor, really, given everything else.
It's not just the growth, like you're saying, it's the quality of it.
Yeah.
Driving sales in women's and kids, especially led by their own brands, that really confirms they know what their customer wants. Yeah. And getting men's back into growth just solidifies that broad appeal. Seems like their merchandising team really has its finger on the pulse.
So they're not just sitting back and enjoying the sales, right? You mentioned investments. What are they actually spending on?
Right. They're definitely reinvesting. CapEx for the quarter was $12 million. Year to date, it's $23.4 million. And they broke that down. $20.2 million for stores and tech upgrades, and $3.2 million for their HQ and distribution center. So investing in both the front-end customer experience and the back-end plumbing.
Makes sense. What about actual store changes? Opening, closing?
Yeah. During Q2, they opened 2 new stores, completed 4 full remodels. One of those was a relocation, remember, part of that off-mall strategy. And they closed 1 store.
So actively managing the portfolio, not just adding doors everywhere.
Exactly. Seems very deliberate. And looking ahead, for the rest of this fiscal year, they plan to open 4 more new stores and complete another 12 full remodels. All this alongside continuing to invest in their digital side. It really paints a picture of a disciplined, forward-looking multi-channel strategy. They're spending, but with clear purpose.
Okay, strong performance, smart investments. But looking ahead, things are always uncertain. What are the potential bumps in the road? Buckle doesn't give formal guidance, right? That's their usual policy, citing safe harbor.
Correct. No formal guidance. It's consistent for them.
But the CEO, Dennis Nelson, did touch on one big macro issue. Tariffs. He mentioned potential cost increases, maybe low to mid single-digit percentages. How big a deal is that for them?
That's definitely something to watch. Nelson did clarify it's a mixed bag. Some vendors, no increase. Others, select brands, are seeing higher single-digit increases. So it averages out, they think, to that low to mid single-digit range overall.
So a potential headwind for margins down the line.
It could be, yeah, if they can't manage it effectively. Historically, though, Buckle's been pretty good at navigating these things, partly because of that strong private label mix we keep talking about.
Right, more control over sourcing and pricing if it's your own brand.
Exactly. Gives them more flexibility compared to a retailer totally reliant on third parties.
Yeah.
So tariffs are a sector issue, but Buckle might have a bit more insulation. Not immune, but maybe better positioned. So for you listening, this kind of reinforces Buckle's story. Disciplined, private label focused, multi-channel retailer. Their operational efficiency really positions them relatively well, even in a tricky environment.
So thinking about the next few quarters, besides tariffs, what are the key things investors should be tracking? What are the main catalysts? And maybe what are some risks or challenges we haven't focused on as much, like that off-mall shift?
Good question. Catalyst-wise, you absolutely want to watch continued momentum in those comparable store sales. That's crucial. Further growth in private label penetration, seeing that 43.5% tick up even higher, would be a strong sign. And of course, successfully executing those store openings and remodels they've planned. Those are the engines for future growth.
Makes sense. And the potential challenges.
Well, besides the tariffs we mentioned, you got to keep an eye on those occupancy costs. Yes, the Q2 increase was tied to strategic growth, but you don't want to see sustained increases there without sales keeping pace or exceeding that growth. And that shift to off-mall locations, while it sounds smart, it's not without challenges. You have to build new traffic patterns, maybe attract slightly different customers. How will they execute that transition and integrate digital with these new physical spots? That's critical.
It's definitely a long game they're playing.
It is. But the market seems to be buying into it for now. The stock popped about 2.4% intraday after the call, closed near $56.
Yeah.
Sentiment on places like StockTwits apparently went extremely bullish.
And it's not just a one-day thing, is it?
No, not at all. The stock's had a great run, up something like 33% over the last 3 months, and maybe 25-30% over the past year. So the market clearly believes in the strategy and execution right now, even with the broader retail worries. The question is always, is that sustainable? Is it priced for perfection?
Always the key question. All right, let's shift gears slightly. Time for our not financial advice segment. This is where we toss out a, let's say, wild but maybe plausible trade idea, like pitching to an investment committee, but, for fun and discussion.
Okay, I've got one. Playing off Buckle's strengths. Given everything we've discussed, the performance, the discipline, that powerhouse private label strategy, how about this? A long Buckle, short fast fashion ETF pair trade.
Interesting. Long Buckle, short the broader fast fashion space. What's the thinking?
The thesis is pretty straightforward, really. Buckle's focus on higher margin private brands. It's careful store strategy. It kind of insulates them from the really brutal, hyper-competitive, promotion-heavy world that many fast fashion retailers live in. They're playing a different game.
So you're betting on Buckle's specific strengths versus sector weakness.
Exactly. You buy BKE, betting they keep leveraging those internal brands and managing costs well. At the same time, you short an ETF that holds a basket of those fast fashion companies. You're essentially trying to capitalize on Buckle's resilience and brand loyalty, decoupling its performance from the macro stuff hitting the less differentiated players. It's a play on a specific operational moat versus sector vulnerability. Bold, maybe, but Buckle's track record makes it kind of intriguing.
Definitely interesting thought. So wrapping things up for today's deep dive on Buckle's Q2, the big picture. A really strong quarter, beating expectations pretty handily. Revenue, EPS up nicely. Significant margin expansion was a key theme, driven by both operational efficiency and that really successful private label strategy, which just keeps growing.
Yeah, a very solid performance. But as we discussed, keep an eye on potential cost pressures from those tariffs down the road. And watch how well they execute on those store development plans, especially the off-mall strategy. Maintaining this level of execution is always the challenge.
Absolutely. And just a reminder, as always, everything we've discussed here is purely for educational and informational purposes. It is definitely not financial advice.
Please, do your own thorough research and due diligence before making any investment decisions. Seriously.
Couldn't agree more. Well, thanks for tuning in to Talk Tickers today. Keep digging for those insights yourselves, and we look forward to exploring what you uncover next.